Progress.
Good morning, good afternoon, and good evening, everybody. Welcome to this episode of the Note Closer Show. As always, Scott Carson, jacked up to be with you today. Thank you always for listening, and or watching if you're watching our YouTube channel, which you can always watch all our videos at WeCloseNotes.tv. Thank you for making it the number one YouTube channel and making this the number one podcast for note investors. Today, I want to talk about something I've been seeing. I don't know about you guys, and gals out there, but I'm so fed up with all the online assholes or people that are giving advice or the idiots that are giving advice that aren't pulling the trigger. You know what I'm talking about. Like, is it a good time to buy real estate? Oh, no, it's a horrible time. Oh, yes, it's a great time. Who is right? And everybody's right and everybody's wrong, depending on their own experience level. Now, if somebody's ever bought any real estate and they're just sitting there claiming, oh, it's a horrible time to buy real estate, they're idiots. They don't have any experience, and they should just shut the hell up instead of giving their opinion. Opinions are like assholes. Everybody has one. So you don't want to take your advice from somebody who's not had any experience. So it's one of the most important things that you've got to realize, especially as a new note investor, or not just a note investor, a new real estate investor looking to get into the business. Now, I've had several phone calls with people calling me the last couple of days and scheduling a call with me to pick my brain about, is it a good time to be a real estate investor? Is it a good time to do syndications or apartments or self-storage or fix and flip? And I'll tell you, yes and no. It all depends on a variety of factors. It's the whole universal answer. It depends, okay? But I came up with these 5 rules after sitting around for a little bit today. What are the most important things if I was a new note investor or a new real estate investor? What's the most important things that I need to know to make sure I don't screw this up? I don't F up my life. All right. And here's the thing that you got to keep in mind. Okay. These are 5 things, maybe 6, and I'll share the 6th thing in a second. Okay. The first strategy, number 1, first rule is know your strategy, know your exit class. You've got to know the exact deal and what type of deals you're going to do inside it out, and make sure, especially right now, that that types of deals you're doing matches up with your strengths and your weaknesses. Okay, if you're not strong in rehabs, I wouldn't be doing rehabs. Okay, if you don't have a team, you're brand new, you don't need to be doing any type of rehab deals. Okay, now that's not saying if you have a team or you can partner up with people that would rehab it. I haven't done a lot of rehabs in the last 5 or 6 years, but I still, when I need to do rehab, I know how to go find right people and get shit done. Okay. But you need to know your asset class inside and out. And I mean, know it, not just know every exit strategy or every class. That's the biggest thing. Just don't try to be a jack of all trades. You will master none of them. Okay. But know your asset class and ask questions. Just don't take the word of the person asking you, telling you, teaching you it. Ask them. One of the biggest issues we see is people that have gotten into syndications, and most of the syndications, especially multifamilies or larger syndications, their whole strategy was to buy this asset that was depressed or work on it to get the asset regentrified, bring it up a level, take it from a B to an A class or C to a B, restabilize rents, add some amenities, and then refinance out. Well, that strategy was their main exit strategy, is get refinanced out in 2 to 3 years. Well, that strategy is gone because interest rates are now double, triple what they were a year ago, and it's going to go up even more with the Fed expected to raise it by another quarter point in the next week. So that's out. So what the heck is your plan B? If A doesn't go well, what's your plan B? If you're only planning for one exit strategy, that's a bad plan of it. If you can't get refinanced out, what's your strategy? If interest rates go up, what's your strategy? If something happens, act of God, COVID, look, not everybody's going to have an answer for everything, but they should have some sort of contingency plan. And that comes in making sure that you're buying that asset at the right point so that either A, you're making money if your cash flow goes down and still covered your expenses, covering your investors. You're also not trying to time the market per se. Okay. Well, we got to time this right. We got to be in and out in 90 days. Well, I know a lot of deals that don't take 90 days. They could take 9 months or a year or more, depending on what your strategy is. So you got to have a plan A, a plan B, and a plan C in a lot of cases. Okay, that's the first thing. But know your strategy, know your asset class, and make sure that asset class, that asset type matches up with your strengths, weaknesses. That you're not, if you've never rehabbed property, you don't need to be rehabbing property. You need to be doing more passive or buying like performing notes or something like that, or lending your money out on private lending, something like that. Okay, that's the first right. Know your asset class, know your strategy. Okay, number two, and here's a fact. I don't care what market you've been in. Yes, it went up and it's gone down. Like people here in Austin, I'm always amazed. There's a realtor guy that I follow. He's talking about buying real estate. People are, oh, Austin's in a crash. No, Austin is in a correction. It's in a price correction. And yes, if you look short term, the last 12 months, yes, it looks like market values are down. It looks like values are down across the board 10 to 15% here in Austin. But are they really? They're still, if you look at the last 5 years, the market's still up 37% compared to what it was 5 years ago. It's still up quite a bit. All right. And if you're looking at that short term 1 year, yeah, if I bought a house a year ago, now I'm trying to sell it, I got to sell it at a loss because I'm paying realtor's commission, closing costs, and or the market has dropped there. Okay. That's not a good short term strategy. If you're a buy and hold kind of guy, or secondly, you got to realize real estate is still going to go up over time. If you're buying and holding on to real estate or holding on assets, it's probably likely going to go up. Okay. Especially if you have the long-term strategy in place. Hey, I'm fine, going to buy this and write it out. Okay. You're going to see values can increase. And if you think real estate is expensive now, wait till 5 or 10 years pass and see how much more expensive it is now. Okay. That's the thing I look at. Real estate compared to what it was in 2008 was much cheaper than it is now. Well, in 10 years from now, or 15 years from now, and 37, 38, it's going to be even more expensive. What was $500,000 now will be $1 million plus. So you might as well get into it, provided, this is the big thing, provided that how you finance it, you can make it work. Whether you're renting it, owner finance the property, or even if you're buying something you're living in for a little while, make damn sure, okay, that you can weather the storm of having the interest. And we're very, very spoiled right now. If you get a 6% interest rate, that's still pretty damn cheap. Yeah, it's not like the 2%ers or the 1%ers. If you can pay to buy down that rate a little bit or whatever it is, 6%, 7% is still very cheap for an investment property compared to 12 or 19 or 9.99% like on a contract for a deed in a lot of cases. It's only gonna get more expensive. So you can buy and write it out for a period of time, or you can afford it and still cash flow, then refinance later on in 2 or 3 years when rates do drop down some and you cash flow more, or the equity has gone up percentage down, and sell it and make more money. That's important. Okay. So make sure if you're don't wait till it drops down, get into it. If the deal strategy makes sense and you can cash flow as the numbers are now and it works for a while, do it. Okay. Third thing, you need to get rid of the idiots. You have to disregard the idiots. We all have idiots that surround us. Okay. Seek counsel from those that are actually doing the transactions, who are doing the deals now, and find out how they are pivoting. Okay. The great place is to go to your local real estate club and talk to people. Hey, how have you changed your buying criteria? How have you changed your investing criteria? What were you doing before and what have you done now? We know that it's gotten more expensive for cost of goods, rehab costs, price of repairs have gone up. I mean, wood, lumber, gasoline, all that stuff has gone up. So are they no longer doing a high end? Are they, instead of putting hardwood floors, they're just putting laminate in? You got to talk to these things. Instead of going to high end appliances, they go low end. Are they going to the scratch and dent store and pulling appliances off? Instead of putting in granite, are they putting in silestone? Are they just putting in regular laminate countertops? Those are questions to ask, but stop listening to people that aren't doing it. Okay. And I see Twitter feeds and TikTok and Facebook and people, oh, it's a horrible time, you should be doing it. And I'm like, you have no experience. So just shut your stupid mouth, shut your pie hole. Acting, no taking action, idiot. Okay. So get rid of the idiots and talk to people that are doing it. They're still buying, because you're really experienced investors who have been through an upturn or downturn or been around for 12 years or longer. They know what to do. They've pivoted their business and adjusted their frame of mind and what their focus is to take in consideration things change. If you've only been in an upturn, those are the investors, those are the realtors that are going to struggle the most. I'll give you a great example. There's a book Keller Williams came out called The $1 Million Real Estate Investor. Well, if you go through that book, over 2/3 of that book those people are no longer investors because that was written pre-2008. A lot of those people lost everything because they were financed to the hilt. And when the bank started calling loans due, when values went down, they lost everything. I know a lot of investors that lost tons and tons of property. So make sure if the market does change and stuff like that, you're taking your advice, taking your counsel from people who've been around for a while, who are positioned to weather the storm or still to be able to do deals or focused on the type of deals that work well. That's why I like debt. I like note investing. People ask me, well, if you buy something at a discount, and the market drops 10%, are you okay? I'm like, yeah, because I'm usually buying at 30, 40, 50% discount off the value. So if the market drops, I'm still sitting okay. I'm still going to be able to cash flow. I'm still going to be able to pay my investors money. I'm just adjusting the terms of how we raise capital by being a longer term engagement of at least 2 to 3 years. Okay. Number 5, you got to embrace the marketing side of business. And embrace marketing doesn't mean yellow letters and bandit signs, however you find deals, that's different. But the marketing side is more so about the raising capital, getting the word out. You've got to embrace tools like using LinkedIn and email blasts and a CRM, even implementing using like AI to write articles, to share your knowledge. You got to share your story because that's how you find more deals. It's marketing. If you're going to want to be a onesie twosie guy and gal, that's fine. You're going to use your own funds and your own portfolio, and you're going to go the slow and steady way. That's fine, totally fine. But if you want to take it to the next level, you've got to embrace marketing. If you want to raise a lot of capital and not just be reliant on what's in your checking account, your retirement account, so you and your spouses, then you really got to embrace the marketing side of business more so than anything else, because that will get you more capital, more deals, and you'll be able to do a lot more things. And that takes us to number 6. But before I say number 6, let's go back and recap those 5 points. The first one, make sure you know your asset class or strategy. 2, real estate's only gonna get more expensive, so you might as well buy now. And if your financing allows you to cash flow now, stick with it. 3, stop listening to the idiots. Seek counsel, not advice. 4, I may have missed this. You've got to understand and know how to raise private capital. This is one thing. I knew I was missing one thing in there, is understand and know the capital raising side. Know how to talk with investors, know what they want to say, know how to market to investors, know how to connect with IRA investors. This is one of the biggest things that we teach in our 3-day class is the capital raising side. You really got to understand that aspect of the thing. Number 5 is embrace the marketing side for deal flow and capital raising. So those are the top 5. Okay. Know your asset class. Real estate's only get more expensive, so you might as well buy now. Stop listening to idiots. Understand raising capital. 5, embrace marketing. And 6, go big, buy more. Number 6, if I look at my history, and if you look at every real estate investor who got started off and is still investing today, their number 1 regret is that they didn't buy more early on. They let their limited beliefs stop them from buying more real estate and taking advantage of the opportunities. And that's a hard thing for people to do. But people are like, oh, I'm just going to buy one. I'm just going to figure this out. I'm going to work this out before I do something else. That's going to be your biggest regret in life. Biggest regret as investors that you didn't buy more when the buying criteria is right. 5 years from now, you're going to wish you bought more now. Now, I wish I bought more 5 years ago. 5 years ago, I wish I bought more 10 years ago. You get what I'm saying, ladies and gentlemen? So go big. All right. Stretch yourself, make more offers. Sometimes making more offers, get more offers accepted will make you embrace the marketing side. It'll make you do more and get outside your comfort level, because that's the only way you're going to grow as an individual, as an entrepreneur, and a real estate investor, is to get outside your comfort zone and start going out and doing it. So don't take no for an answer. Go find the answers out there. You can always book a call with me at talkwithscottcarson.com. Ladies and gentlemen, I'll take you directly to my calendar, talkwithscottcarson.com. I'm here to help you, ladies and gentlemen. If I can help in any way, please reach out. Please keep the comments coming, whether you're sharing this to your network on social, or you're leaving a comment on our reviews, or you're leaving a comment on YouTube. Share comments. We're always glad to answer them, and we love to see that interaction. So thank you again for helping make this the number 1 podcast for note investors. And go take some action. Take those top 5 and top 6 strategies and lessons. I call them, I guess you could call them the 6 commandments of investing in 2023. Go out, take some action, everybody. We'll see you at the top.